This is terrifying, and it's destroying the global economy. I'm your host, Steven Van Metre, and thanks for joining me today. And we're about to experience an unparalleled amount of demand destruction that's going to send the global economy crumbling down. Let's head over to Bloomberg, where we picked this story up, who headlines that the U.S. and U.K. ban Russia oil imports, amping up the squeeze on Putin. And here we see Russian oil makes up about 3% of all the crude shipments arrived in the U.S. last year, which isn't a whole lot. But when other petroleum products are included, such as unfinished fuel oil that can be used to produce gasoline and diesel, Russia accounted for about 8% of 2021 oil imports, though those shipments have trended lower in recent months. And that's going to be a huge problem, as you can already know, it's sending gas prices higher. And now we see the Wall Street Journal, who headlines that gasoline prices surge above $4 a gallon with no end in sight. And the timing of this is absolutely terrible, because what's happening out in the economy is employers are asking the workers to say, hey, you need to come back to the office, which means you got to get back in your car and fuel it up and start commuting at a time where we do not have any more fiscal stimulus, where monetary stimulus is about to end this week, and we're going to likely get a rate hike next week and go into a tightening cycle. And all of a sudden, consumers who have less money are going to find themselves squeezed, and that's going to have a domino effect across the rest of the economy. Let's continue on, because traders and shippers are shunning Russian oil, pulling millions of barrels from global supplies and powering new increases at the pump. On Monday, the national average price for regular gasoline hit $4.06 a gallon, the highest since July 2008, and approaching the record of $4.11 reached the same month, according to AAA. The managing director of global energy strategy at RBC Capital Markets said that after 2 years of COVID-19, he expects consumers to hit the road, even with high gasoline prices, if you can imagine that. The last time rising gasoline prices curbed demand was in 2008 amid a spike in oil. Sound familiar? During the financial crisis, which is coming. Back then, of course, gasoline rose to a record $4.11 a gallon, which equates to about $5.20 a gallon today, adjusted for inflation. And of course, you're wondering, how can somebody think that demand is still going to be there? Well, let me show you why he thinks that. The average U.S. household has about $700 more in its bank account today than before COVID-19 struck, giving consumers more room to absorb higher costs despite the broader inflationary pressures. There's still a lot of pent-up demand for driving, for travel, and just living again. But as you know, $700 doesn't go far. And depending on the gas mileage of your vehicle, it may go even less than many other people. But what's going to happen is a lot of discretionary spending is going to be rerouted into energy costs. It's going to leave less money for travel, less money for other things, and that's going to have a massive impact on the economy. And here you can see the gas prices, according to the Federal Reserve database, are back near their 2008 highs. And while many people worry that prices are going to keep going higher, what they actually do is they start to tighten financial conditions, and they lead to lower gas prices as demand goes away. Now, unless gas prices come down like they did in 2015 on their own, well, then, of course, you're more likely to see a recession. And, of course, that's terrifying for sure. And now let's switch gears a little bit, because we're also going to see some demand destruction from the production side of the U.S. economy. And higher vehicle energy imports pushed January U.S. trade deficit to a new record as U.S. imports rose while exports fell, leaving the trade deficit at $89.7 billion at the start of the year. Economists expect the Russia-Ukraine crisis to disrupt trade this year. Well, expect it is. The rise in imports reflected strength in the U.S. consumer demand, according to chief economist at Amherst Piermont. He added that Russia-Ukraine crisis and strengthening the U.S. dollar, which is a huge problem, could push import totals higher in the months ahead. And of course, if you know what a higher dollar means, it means financial conditions are tightening. So you have not only higher energy prices, but a stronger dollar. And when you see what the dollar can do to the U.S. economy when it gets too high, well, it has big impacts. The widened deficit in January reflected a pickup in demand for foreign-made imports, well, mainly because they're a lot cheaper now as businesses restock shelves, but demand for U.S. exports weakened. That would be due to the strong dollar. In January, many businesses struggled with Omicron-related absenteeism. Rising energy prices affect distribution and ongoing supply chain disruptions. And here you can see what this means for the U.S. economy is GDP growth is going to head lower as it tends to follow the trade deficit, which is now new all-time record. How about the dollar? Well, when the dollar goes higher and gains strength, as you can see here, it usually means the trade deficit widens. And now, again, at record levels, and the dollar is still heading higher. Well, you can only imagine that from an import-export perspective, you see domestic production will then go down and foreign production will go up as they seek to import to the United States. And again, another factor that's not being really talked about in the energy sector is this will spur an increase in foreign imports of oil and other goods and services, and that ultimately brings inflation back down. And of course, we could see from Treasury yields, which right now everybody believes that yields are going higher. Well, we know that when there's a big trade deficit, those dollars get recycled back into the United States through purchasing our debt, meaning yields are more likely to go lower than higher. And of course, we also know that periods of high inflation lead to a recession and lower treasury yields. And you see that here back in the early 1990s. You can see that in the 2000s, inflation going up in blue, yields going down in red. We see that in the mid 2005. We see the great financial crisis. We see that around 2011, and we saw that in 2018. And likely we are going to see that again, except this time we're going to head into recession. And if you're concerned how your portfolio might behave in a recession and you're looking for something that hedges and controls that downside risk, well, be sure to check out Portfolio Shield. I'll put a link in the corner of the description below. You'll be glad you did. Let's continue on, because another area we're seeing demand go away is in consumer credit. And I've talked about how this will lead to layoffs. And here you can see in January, the U.S. consumer credit was projected to be at $23.8 billion. In the prior month, it was just over $22 billion. Came in at $6.84 billion. So what that tells you is U.S. consumers were shopping because we know they went out. We saw the retail sales report from January, and it was good. What it meant, people were paying in cash and not charging it. And when Americans aren't charging, it tells you they're not confident in the economy. They're not confident about their ability to make that payment in the future. So they're paying with cash now before prices get too high. And without any surprise, we can see online mortgage lender Better fires 3,000 people in a new round of cuts. And of course, online mortgage lender is firing 3,000 employees in U.S. and India as rising interest rates weigh on the volume of new loans, which of course we're getting that data tomorrow, which we can already predict is likely to head lower. The toll represents 35% of the company's workforce, according to a person familiar with the matter who asked not to be identified. And as I mentioned before, and you can see why this is terrifying, it's not only higher rates are tightening financial conditions, you have a higher dollar is tightening financial conditions, and you have higher energy prices that are tightening financial conditions. And it's the same recipe that we saw as we headed into the great financial crisis in 2008. And with that, I'm Steve Van Metre. Thanks for watching. Bye now. The content of this video is private educational information only. It's not intended to provide investment or other advice. This video is not to be construed as a recommendation or solicitation by study security, financial product, instrument, or participate in any particular trading strategy. This video was prepared by Steve Van Metre. Personal capacity, opinions expressed in this video that I know do not affect the view of Atlas Financial Advising or Steven Van Metre Financial.